Okay, let's dive right in. Cryptocurrency, I mean, it feels like it's just everywhere these days.
It really does.
You see it dominating headlines, these huge market swings, and honestly, it feels way more accessible than it used to.
Uh-huh. But yeah, wading into this space, it comes with a lot of complexity.
And definite risks, right? Big risks.
It's absolutely a landscape that's, constantly shifting. Trying to make sense of all the noise is really key.
Whether you're just trying to stay informed or maybe even thinking about getting involved yourself.
Exactly.
Which is why today's deep dive is focusing on your stack of sources. We're going to try and unpack everything they cover about crypto, investor protections, those inherent risks.
And sort of map out what the landscape looks like right now here in 2025.
Yeah, pulling directly from the material you shared.
So the mission, really, is to help you navigate this space. We'll break down the fundamentals, understand the appeal, but also the pitfalls.
Learn how to spot those red flags for potential fraud.
Right. And explore really different ways regulators across the globe are trying to keep up. It's quite a mix.
Ready to sort through the buzz then?
Let's do it.
Okay, let's start with the absolute basics. According to the material, what is this virtual currency we keep hearing about?
Well, the sources describe it as a digital representation of value. Simple as that, really.
Okay.
It often, positions itself as an alternative, maybe even a replacement for traditional money. And fundamentally, it all runs on blockchain technology.
And this seems critical right up front. These virtual currencies, they are not backed or supported by any government or central bank.
No, not at all. Their value comes purely from market forces, supply and demand. That's it.
Which makes them inherently volatile. The material is very clear on that.
Extremely volatile.
Yeah. Now, when most people think virtual currency, let's be honest, they probably think Bitcoin.
Usually, yes.
And your sources confirm it's what they call a convertible virtual currency, and it's still the biggest by market cap right now.
Right. And its origin story is, well, it's almost mythical now, isn't it? Created back in 2008 by this figure, or figures known as Satoshi Nakamoto.
With this really powerful core idea, an electronic payment system built on cryptographic proof.
Instead of needing, a trusted third party like a bank.
Right. And that core idea gives Bitcoin some pretty defining features. It's described as pseudonymous. What does that actually mean in practice?
It means you're identified on the network by, a public address, letters, and numbers, not your real name.
Okay.
So transactions are public, but tying that specific address back to you isn't straightforward unless, you use a service that requires ID checks.
Got it. And it obviously relies heavily on cryptography.
Oh, absolutely. Digital signatures, public and private keys, complex algorithms. That's the security backbone.
And it runs on this decentralized peer-to-peer network. You mentioned miners.
Yeah, think of it like a global network of computers running this open source software. These are the miners. They perform the work.
And that work is
what
exactly.
It's essentially solving really complex math problems. They compete to do it.
Okay.
And the first one to solve the puzzle gets to validate the latest batch or block of transactions and add it to the blockchain.
Yeah.
This takes a ton of computing power.
Which makes it expensive and difficult to cheat the system.
Exactly. That's the idea.
And those validated transactions, they go onto the blockchain. The sources call this a permanent public distributed ledger, visible to everyone on the network.
And once a transaction's on there, it's designed to be, well, basically impossible to change, irrevocable.
So the real innovation here is enabling value transfer between, say, two strangers.
Right.
Without needing a bank or anyone in the middle to guarantee it. It solves that trust issue using math and this proof of work.
Precisely. That's the core concept.
That mix of cool tech and this decentralization philosophy, it seems to really resonate, doesn't it?
It does.
The material notes it's particularly appealing to a younger crowd, maybe more open to risk or just interested in new tech.
Yeah, there were even anecdotes about high school, middle school kids talking about it.
And that survey finding, wow, over 20% of college students with loan debt using financial aid to invest in crypto.
That really jumped out at me, too. It just shows how widespread the interest is, even among people maybe without huge amounts of spare cash.
Okay, so that covers the what and some of the why. How do people actually, get crypto, and what are the immediate risks they face?
Well, the sources point to two main ways. The most common is just buying or selling virtual currencies directly using traditional money like dollars.
On a cash or spot market platform.
Exactly. And then that crypto goes into your personal digital wallet.
Okay. And the other way is through initial coin offerings, ICOs.
Right. ICOs are basically a fundraising method for new crypto projects.
Like if they're building a new platform or some software.
Yeah, exactly. They issue their own specific token or coin to raise capital. And this token often promises some kind of utility within that project's world.
What kind of utility? Like access to a service or maybe voting rights on the project?
Could be. Or discounts later on. It's tied to the project's future use, not just meant to be a general currency.
Gotcha. Now, when you start using these markets, especially the cash platforms, the sources hammer home some pretty significant risks.
Oh, definitely. A major one is that most of these cash markets operate without any government regulation or supervision.
So, completely different from, say, the stock market.
Very different, which means the platforms themselves might lack robust safeguards. Customer protections could be weak or just not there.
And the volatility we talked about, that's a huge risk in the cash market itself.
Massive price swings, flash crashes, and yeah, market manipulation is a constant worry.
Plus cyber risks, right? Like someone hacking your wallet on the platform.
Always a threat. And an interesting point from the material. Sometimes the platforms themselves might be trading against their own customers.
How so?
Selling from their own accounts, maybe? Putting individual investors at a real disadvantage? These are serious things to think about.
Okay, so those are kind of the baseline risks. But the crypto market, Bitcoin especially, has been on such a roller coaster. The sources talk about this comeback narrative over the last couple of years, 2023 to 2025.
Oh, it's been a wild ride for sure. Remember Bitcoin hitting nearly $20K back in 2017?
Yep, then the crash in 2018.
Then it surged up to $69,000 in November 2021, only to fall into that crypto winter, dropping below $20K in 2022.
But the recovery since then has been pretty dramatic, from around $16,625 in January 23.
To $45K by Jan 24, then soaring past $90K by November 24.
And even touching $108,000 in December 24 before settling around $93,300 at the start of this year, 2025.
It's quite a climb. And the material suggests several factors came together to fuel this 2024-2025 surge.
Right, like what?
Well, one really big one was the approval of spot Bitcoin ETFs in 2024.
Right, that was huge news. Explain again what a spot Bitcoin ETF is and why it mattered so much.
Okay, so think of it like this. Instead of you having to buy Bitcoin directly, figure out wallets, security, all that.
Which can be complicated.
Yeah, very. Instead, you buy shares in a fund, and that fund holds the actual Bitcoin. The share price tracks the real-time or spot price of Bitcoin.
Ah, okay. So it lets traditional investors get exposure using their regular stock brokerage accounts.
Exactly. And crucially, these ETFs are regulated products. They fall under SEC oversight.
So that opened the floodgates, basically. Broadened accessibility massively.
Precisely. A whole new pool of investors could suddenly participate more easily. Another key factor mentioned was the Bitcoin halving event in April 2024.
Ah, yes, the halving. That's baked into Bitcoin's code, right? It happens every 4 years or so.
Roughly, yeah. And it cuts the reward that miners get for adding new blocks to the chain in half.
So it went from 6.25 Bitcoin per block down to 3.125.
Correct. And the effect is pretty straightforward. It slows down the rate at which new Bitcoin enters circulation, reduces the supply growth.
And historically, these halvings have often preceded price increases.
They have. Often linked to this idea of increasing scarcity, plus all the media attention the event gets. The next one's expected around 2028, by the way.
Interesting. What else did the sources point to?
Political developments in the U.S. were also highlighted.
Like the November 2024 election.
Yeah. Donald Trump's re-election happened right as Bitcoin was breaking past $90,000. And some interpreted that as, cementing confidence in a potentially more crypto-friendly regulatory environment.
And related to that, the material mentioned specific appointments or proposals.
Right.
Yeah.
Like Paul Atkins being nominated to lead the SEC. He's described as, conservative, maybe anti-regulatory, and he's been part of a crypto industry group.
Okay.
And there was also a proposal for a new presidential advisory council focused on digital assets.
Any other policy-related factors?
Proposed tax reforms came up too.
Yeah.
Specifically, the idea of lowering capital gains tax. That could make crypto investing more attractive, letting investors keep more of any profits.
Makes sense. So policy, having ETFs, and just generally easier access.
Exactly. User-friendly platforms. The sources mention names like Coinbase, Binance, Kraken. As examples, they've just made buying and selling much simpler for everyday people.
You don't need to be a tech wizard anymore.
Not like you used to. These platforms, plus the ETFs, they've really broken down barriers, managing private keys, hot wallets, cold wallets. that complexity is less of an issue for many now.
And it seems to be shifting the perception too, right? From
Yeah.
something niche or purely speculative.
Yeah, towards potentially being seen as just another part of a diversified investment portfolio, accessible through the same apps you use for stocks and bonds.
So you get this kind of perfect storm, really. Factors boosting accessibility, driving up the market.
But, and this is a big but, in the sources, more access for legitimate investors also means more opportunity for fraudsters.
And the key insight here seems to be the tech might be new, but the scams, they're the same old tricks.
Absolutely. Fraudsters are just adapting classic cons using crypto as the bait. The material lists some common red flags that you should definitely watch out for.
Okay, like what?
Things like superficial signs of legitimacy, a fancy website or office that looks official but maybe doesn't have much substance behind it.
Urgency is a big one, isn't it? Pressure to invest right now.
Huge red flag.
Yeah.
And promising massive guaranteed returns. That example tweet they included promising 7x return guaranteed. I mean, come on.
If it sounds too good to be true.
It almost certainly is. Also, watch out for anyone offering you a special favor or using really aggressive, high-pressure sales tactics.
And confusing explanations, too, if they can't explain clearly how the investment works or it just feels overly complicated.
Be very, very wary. If it doesn't make sense, maybe there's a reason.
The sources even use that howiecoins.com example, the fake site the SEC set up.
Yeah, brilliant educational tool. It basically demonstrated all these red flags in one place.
Like what specifically?
Well, Howie Coins claimed high, guaranteed returns, talked about anticipating daily growth, even called itself a guaranteed hedge. Classic scam language.
And it used celebrity endorsements, didn't it?
It did. And the material warns you should always check out anyone promoting an investment, especially celebrities. They might not have done their homework, or worse, could be part of the scam.
Another big one on Howie Coins was claiming to be SEC compliant.
Right. And the sources note that SEC staff are really concerned about platforms falsely claiming this. It gives a false sense of security when they aren't actually registered or regulated by the SEC at all.
That's sneaky.
Very. And Howie Coins let you invest with a credit card. The material explicitly advises against that. Stick to licensed, registered firms and don't fund investments with credit.
Finally, Howie Coins even advertised a pre-planned pump right after its pre-ICO, promising huge returns, like over 225%.
Textbook pump and dump. Fraudsters hype up the price with false information, attract buyers, then dump their own shares, crashing the price and leaving everyone else holding worthless tokens.
And these are just theoretical risks. The sources mention real-world examples.
Yeah, like Canada's crypto king, Aiden Pladersky,
Yeah.
charged with fraud, allegedly took over $40 million from investors while, living this incredibly lavish lifestyle.
It makes you stop and think, doesn't it? How does that happen? Why do people fall for it?
It's a good question. And then there was that really disturbing headline provided in the sources.
The one about the wealthy crypto king turned NYC townhouse into torture chamber to gain partners Bitcoin.
Yeah. I mean, that's an extreme example, obviously, but it just underscores the potential for serious criminal activity around this stuff.
And investigating this kind of fraud must be incredibly difficult for law enforcement.
Hugely challenging, especially with ICOs.
Yeah.
Tracing money across different blockchains, different wallets, it's tough.
Plus the international aspect.
Exactly. Jurisdiction is messy. There's no central authority to subpoena for records. And physically freezing or seizing digital assets isn't straightforward, like seizing cash from a bank account.
Still, the SEC has been taking action. The material cites various enforcement efforts.
Yeah, things like trading suspensions against companies just trying to capitalize on the crypto hype, specific cases against fraudulent ICOs like Recoin or PlexCore, and actions against unregistered exchanges like Bitfunder, where there were also fraud allegations.
Okay, so that's direct investment scams. But the sources also talk about crypto being used in broader illicit finance, right?
Yes, definitely. Sanctions evasion is a major concern highlighted.
They named specific platforms?
Yeah, a platform called Garantex was mentioned as being used for this. And OFAC, that's the U.S. Treasury's sanctions arm, has sanctioned Russian-linked wallets involved in these complex money laundering chains, moving funds through multiple transactions and exchanges.
And the material listed specific red flags for money laundering using crypto.
It did. Things you might see, like multiple transactions with no obvious business reason, or lots of large transfers coming from many unrelated accounts into one wallet very quickly.
Okay.
Also, account activity that just doesn't fit what you know about the customer, Or, conversely, lots of small deposits from random accounts that are then quickly consolidated and withdrawn as regular cash.
Interesting. Now, this leads into a really stark viewpoint presented in the sources from a group called VinciWorks.
Yes, their take is pretty strong.
What did they argue?
Their opinion, as stated in the material, is that crypto should always be treated as high risk because, in their view, its only real benefits are for criminals.
Only benefits. That's quite a statement.
Yeah, they argue it's perfect for money laundering, sanctions evasion, terror financing. Because illicit cash can be converted and moved globally in seconds, used to buy weapons or pay off criminals, all without touching the traditional banking system.
And they think this risk is actually increasing now in 2025.
That's their perspective, yes. Vastly increasing.
Wow. I mean, how do we square that view that its only use is illicit with what we just discussed about, say, regulated Bitcoin ETFs available through major brokerages?
That's the tension, isn't it? And the material really highlights this divergence. You have traditional finance finding regulated ways to get involved, like ETFs, but at the same time, the underlying tech, the decentralized nature,
Yeah.
as VinciWorks points out, it can still be exploited for illicit purposes in ways that are really hard for authorities to track and stop.
It's like it has this dual nature.
Exactly. And that duality is what makes regulating it so incredibly challenging for governments around the world.
Which brings us neatly to the regulatory landscape itself, which, as you said, sounds like a real patchwork right now. Regulators are scrambling.
They really are. The sources mention key players, like the SEC in the U.S., focused on investor protection and market fairness.
And the CFTC.
Right, overseeing commodity futures, doing outreach, and maintaining things like their red list, which flags unregistered foreign companies targeting U.S. investors.
But globally, the approaches seem all over the map. The European Union has its MiCA regulation.
Right, Micah. That's the EU's attempt to create a harmonized framework. It tries to categorize different crypto assets, like those for payments, those backed by other assets, or ones that look like securities and apply specific rules.
What kind of rules?
A big one is mandating identification for both the sender and recipient on all transactions, no matter the amount. And stricter Know Your Customer, or KYC rules for larger wallets, say over 1,000 euros. The goal is alignment with traditional finance rules to reduce risks.
Okay. Then you have China, which took the complete opposite approach.
The most extreme, yeah. A comprehensive ban. They banned ICOs first, back in 2017. Then in 2021, a total ban on trading, exchanges, even mining.
Why such a hard line?
The sources cite concerns about financial stability, curbing illicit activities like money laundering, and also the environmental impact of crypto mining.
So what happened?
Exchanges and miners basically packed up and left. And Chinese citizens are barred from using foreign exchanges. China's focus now seems to be more on the underlying blockchain tech itself and their own state-backed digital currency, the ECNY.
Interesting. What about India? The sources described it as being in regulatory limbo.
Yeah, that seems fair. The central bank tried to ban crypto services in 2018, but the Supreme Court overturned that ban in 2020. So the market's basically operating in this largely unregulated space, relying mostly on industry self-regulation. And this uncertainty, despite India having a massive user base,
It probably hinders investment and innovation, right?
seems likely, yeah, compared to places with clearer rules.
Like Japan, maybe? The sources presented Japan as having a more regulated environment.
Yes, especially after they suffered some major exchange hacks years ago. That spurred them to implement stricter requirements.
Such as?
Things like mandatory cold storage, keeping assets offline, enhanced compliance rules under their VASP Act, that's Virtual Asset Service Providers.
Okay.
It requires things like proper due diligence, KYC/AML checks, holding sufficient capital reserves, keeping customer funds separate, having strong security measures. The goal is clearly better investor protection and guarding against cyber threats. Japan's also looking into CBDCs and blockchain tech, like China.
Right. And then there's a really fascinating and maybe controversial case, El Salvador.
Ah, yes. The country that adopted Bitcoin as actual legal tender. Unprecedented move.
How did that play out?
Well, the government rolled out a digital wallet called Chivo, even gave citizens $30 worth of Bitcoin to get started, and installed Bitcoin ATMs.
But the sources highlighted some serious risks with this approach.
Oh, definitely. A major concern is the lack of robust anti-money laundering. And Know Your Customer regulations, AML/KYC.
Why is that a problem?
It makes it hard for local businesses to comply with international standards, and potentially easier for criminals to launder money or illicit tokens. maybe by converting them into things like luxury goods or real estate within El Salvador.
And didn't Fitch, the rating agency, raise flags?
Yeah, Fitch noted concerns that Salvadoran banks hadn't fully met international standards like Basel II or the Third, and pointed to increased operational cyber and money laundering risks from Bitcoin adoption.
The sources also mentioned broader concerns about governance in El Salvador.
Right. Things like democratic backsliding, corruption allegations, U.S. sanctions on some officials. President Bukele's style was described as rule by tweet, and actions like removing judges were mentioned.
And potential scrutiny from the FATF, the International Anti-Money Laundering Body.
Yeah, concerns about potential gray listing or blacklisting, which would trigger more scrutiny for transactions involving El Salvador.
And the material suggested Bukele might be more focused on winning over crypto fans.
That was the suggestion, yeah. Appealing to crypto advocates, maybe his good friend Donald Trump, as the source put it, rather than fully addressing these international regulatory concerns.
Okay, wow. So we've gone from the basic tech through the market madness, the surge drivers, the scams, and now this global regulatory mess. Based on all of this material, what does it boil down to for you, the listener, if you're thinking about engaging with crypto?
Well, the sources offer a very practical set of questions you should ask yourself before doing anything.
Crucial questions derived right from the risks we've discussed.
Absolutely.
Yeah.
First, where is your money actually going? What will it be used for? Is there any chance it's just paying off earlier investors? You know, like a Ponzi or a pyramid scheme.
Good point. Then, who is issuing and sponsoring this product or project? What's their background? Are they credible?
Do they have a clear, written business plan? And importantly, do you genuinely understand it? If it's confusing, that's a warning sign.
How, when, and at what cost can you actually get your money out? Can you sell your investment easily? Do you have any right to return the token or get a refund if things go south?
Has the whole thing been structured to comply with securities laws? Now, that's a bit technical, but compliance offers you certain protections as an investor.
What legal protections, if any, are available if there's fraud or a hack or malware, or even if the project just fails?
And finally, maybe the most critical one. Who is ultimately responsible for giving you your money back if something goes terribly wrong? Is there anyone?
Asking these questions, which comes straight from the source material, seems like the absolute minimum homework you need to do.
Definitely. So just to recap, we've sort of unpacked what virtual currency is, traced Bitcoin's wild history, looked at the recent surge drivers, ETFs, halving, politics.
We've faced the uncomfortable truth that old scams are thriving in this new space.
Right. And seen how differently countries are trying or sometimes failing to regulate it all, with some pretty controversial results like El Salvador.
And the whole point of this deep dive was really to help you get up to speed quickly, drawing on all this information from your sources, to give you a clearer view of this fast-moving space.
Equip you with tools to spot potential trouble.
And understand the bigger picture, the forces shaping this market.
So maybe the final thought to leave you with is this. Given how easy it is to access crypto now, and the undeniable allure of potentially high returns, but also seeing these persistent, sometimes really stark examples of fraud and illicit use, how do you balance that opportunity against those inherent risks? What does responsible participation in this constantly changing environment truly mean for you?